Hello guys, it's Farjad. I'm recording these stories. This stories because over the years I've seen the same pattern repeat itself. Founders, managers, a smart team with real product and real effort, they don't fail because they're lazy, they're not talented, or the wrong decision. Especially when it comes to business model and money. In the previous episode, we talked about one core idea. A business model isn't a name, it's not subscription, it's not marketplace, it's not SaaS. A business model is a set of decisions about how value created, delivered, and captured. That episode was about changing how we look at businesses. This episode is about facing reality because many businesses don't die because of the bad idea or weak themes. They did right there, here, right here, right. They die right here at the point where they don't understand how money actually flows. Um, Today, we're not talking about pricing. We are talking about when money comes in, how often it repeats, and whether it's designed as a system or just happened by accident. If you haven't watched the previous episode, I recommend starting there. And this episode is direct continuation of that map. And if you did watch it and you're still asking yourself, where does the money real come from in my business? Then this episode is for you. Let me share my screen at the same time. Show yeah here, and let's dive into. So let me start with a strange story. Look at this timeline. In this a specific business model, the customer pays today, point number one, and the value is delivered, but the supplier, the people who actually make the product, they get paid much later. Point number three. Between point number one and point number three, there is a time gap for a period of 30 or 60 or even 90 days. these company uh, this company is handling cash that technically belongs to its suppliers. No tricks, no debt, just time. Keep this image in your head. We aren't going to name it yet, but understanding this gap is the difference between a small business and a empire business. So let's be honest with you about failure. Most businesses don't die because their product is bad. They die because the money engine stops working. Everything else on the surface looks fine. The brand is cool, the team is busy, but underneath, the engine collapses quickly. If I ask you right now, what's your revenue model? And you say, well, sell this for $50, I'd have to stop you. That's not a model, that's a price. And confusion, the two, is a fatal mistake. The single most important question you need to answer today is this. When does the money arrive? Does it hit your bank account before you deliver value or after that? That single decision changes who carries the risk. It changes how fast you can hire, how much pressure you can survive. If you're chasing clients for checks after you've done the work, you aren't just postpaid. You are carrying the entire financial risk of the transaction. Let's draw the line clearly. Pricing answer one simple question is how much. It's just a number, but the revenue model answers three deeper questions. One, how does the money move? Two, when does it move? And three, why does the customer accept that movement? Stop optimizing your price and start designing your flow, because a bad flow with a good price is still a bad business. Here is a critical insight. Why do investors love SaaS? Why do they love subscriptions? It's not just because of the profit margins. It's because of predictability. Look at this AI chart exactly. Predictable cash flow allows you to plan. Planning allows you to hire. Hiring allows you to grow. If your revenue is a surprise every month, you aren't growing. You are just accelerating toward a wall. We need to move you from random sales to a predictable system. So, how do we build that systems? There aren't a million business models. There are really just for the families. For distinct logics of money. One, subscription. The logic of rhythm. Two, razor and blade. The logic of lock-in. Three, freemium. The logic of scale. And finally, four, cash matching. The logic of time. Let's break them down one by one and see which one fits you. First, subscription. This is the logic of Rhythm. You aren't selling a product here. You are selling a repeated behavior. But here is the trap. This only works if the value is consumed naturally, daily or weekly. Think about Netflix or Slack. You use them every day. The critical test is simple. If the habit doesn't exist, subscription feels abusive. If your customer only needs you once a year, don't force a subscription on them. They will churn and they will hate you. Second, razor and blade. This is the logic of locking. The strategy is simple. You lower the barriers to entry. You sell the core product, the razor, the printer, the coffee machine, cheap, sometimes even at a loss. Why? To create dependency. The real money comes from the repeats, the blades, the ink, the pods, the other one. But the warned make living painful. If I can buy generic blades for your razor, your model fails. Without the locking, this isn't a business strategy, it's just generosity. Third, freemium. This is the logic of scale. Many startups die here. They think freemium is a revenue model. It's not. It's a distribution bet. In this model, most users will never pay you a dime. A tiny minority must love the product enough to pay for everyone else. This only works when the cost of serving one extra user is near zero. If you have high support costs or physical goods, freemium is suicide. You will bleed out slowly while celebrating your user growth. Fourth, the cash matching. This is the logic of time. Get paid early. Pay your costs later. Let the time gap fund your operations automatically. This is how Dell and Amazon were built. But this requires extreme discipline. If you take the money early and waste it, the collapse is brutal. This model rewards operational excellence. So, which one is best? None of them. Context beats preference, always. If your product fits a habit, choose a subscription. If you can lock them in, choose a razor and blade. If you need massive scale, choose freemium. If you have leverage, choose cash matching. There is no best model. There's only alignment between your customer's behavior and your money's behavior. Now, I warning before we finish. Remember the remember the four pillars. I'm so sorry. Oh, what happened to my voice? So I just saying a warning before we finish. Remember the four pillars from episode one: value, tech, distribution, and financial. Everything we discussed today sits in just one pillar: financial. Subscription fails. One pillar that is financial. Subscription fails without recurring value. Cash matching fails without a strong distribution. Money is part of a system. It's not a shortcut around the system. Now let's go back to that strange story from the beginning, slide one. The company was Amazon. Customers pay, um, money arrives early, value is delivered. Supplier is paid later. That time gap, that wasn't an accident. That gap funded the warehouse, the infrastructure, and the massive scale. It was a specific business model decision. The real question isn't whether Amazon is smart. The real question is, could your business survive making that same decision or not? From this point on, I want you to change how you strategize. Uh, that's it. Stop asking, how much should I charge? Starting asking, does the money repeat by design? Start asking, when does the money arrive? Money is either an accident or it's a system. You choose. In the next episode, we move. Okay. In the next episode, we move from money to power, platform, ecosystem, network, and effects. Because the strongest business don't just control cash; they shape behavior at scale. Let me stop my share screen before we end the here. Sure. So, um, thank you for your time and interest in building a better business architecture. If you are looking for a specific consultation on your model or support with a business, a startup, or something like that, connect with us. We are Ashavid. We work with founders, entrepreneurs, and business owners who want structure, clarity, and honest guidance. You can find us on LinkedIn, YouTube, Twitter, TikTok, and other social platforms at Ashavid or Ashavid Group. Send us a message, tell us where you're stuck, and we'll take it from there. These stories will continue. This is Farjad and signing off. See you in the next episode. Bye.